You're listening to QSBS Solved, the only podcast dedicated to having candid conversations with leading experts in tax, law, M&A, and startups about qualified small business stock. QSBS is the single greatest opportunity founders and investors have to keep more of what they earn at exit and compound value in the startup ecosystem. The content of this program is intended for informational purposes only and does not constitute tax, legal, or investment advice. Views represented by guests and hosts are not always representative of their affiliated organizations. Enjoy this week's episode and reach out to our team at QSBS Rollover by visiting QSBSrollover.com. Everyone, welcome back to another episode of QSBS Solved. I'm here with Blaine Woodson today. Super excited. Blaine is a manager in the National Tax Office at Grant Thornton Advisors, and he's based in Washington, D.C. He's one of the firm's QSBS subject matter experts and a regular contributor to the firm's educational resources around qualified small business stock as well. Blaine will also be joining us in Jackson Hole this September for the 2026 QSBS Summit, and we hope you will too. But be sure to act fast because registration is closing on August 1st for the summit. But thanks again for joining us today, Blaine. It's great to chat with you. Thanks for making time.
Yeah, great to be here.
Why don't you tell our listeners a little bit about your practice at Grant Thornton on the corporate side and what that looks like in your day-to-day, the types of transactions and questions, problems that you deal with in your day-to-day practice. And we can jump in and talk a little bit about conversions, entity conversions, especially S-Corps to C-Corps for QSBS.
Yeah, of course. I think given where Grant Thornton is situated in the market, most of our clients are middle market companies or private equity firms. We tend to do a lot more what I'll call corporate QSBS work. So advising companies as they're going through an exit, advising founders as they start their businesses, sometimes the midstream liquidity events, stuff like that. So we really focus on the corporate level QSBS considerations. So that's, looking at making sure you're staying engaged in a qualifying trader business. If you're, hot topic right now for software companies is they generate a lot of cash. They don't have a lot of overhead. That can be a problem from a QSBS asset test perspective. And so we kind of serve, end-to-end corporate solution for our QSBS clients, providing compliance services, advisory services, and then ultimately exit services as they're looking to sell the business. I do as well, of course, do some shareholder level work, but the bulk of our work is in that core sort of corporate M&A world.
I know we're going to talk about conversions, but I'm kind of interested to linger on the asset test statement that you made around software businesses. It seems like software companies just continue to get leaner and leaner and leaner in their operations. Some of the biggest line item expense for those types of businesses were engineers, and now we see a whole engineering team is getting replaced by AI, and that's certainly not the case, at the largest companies, but especially in early stage businesses, teams are getting to market with a much lighter, developer stack than they used to, and thus maybe a little bit higher margins. As just the landscape around some of these startups changes, like has your perspective on the way that those asset tests should be handled, the way that cash should be handled, how has that changed for you over time?
Yeah, I mean, the law is the law at this point. Unfortunately, we have not received the regulation package from the Treasury yet. We're hoping to see that later this year. But, the government has acknowledged that 1202 has not caught up to what I'll call the post.com boom. The statute was written in 1993 when, the internet was in its fledgling stages and tech companies were producing physical technology much more than they were, what I'll call virtual technology. And so I think it presents a unique challenge for taxpayers and frankly, also for the government to think about how do we bring a statute that was really at its inception designed for inventory intensive businesses into a global economy now that is, they may not have any quote unquote inventory. It may be literally a zip file you pull down from a download portal. So, I'm seeing founders kind of and companies deal with this in a variety of ways. The first is probably the most obvious is just, you take the tax hit during operations and just make a distribution of cash up and out. While this is maybe not the best, from a tax planning perspective, because these are typically fairly profitable businesses, they may have a large amount of NOLs from the early days. But as we've all seen, these tech companies either skyrocket or plummet. And so they could have a large amount of E&P, which would create dividend leakage. You could maybe bonus out some of your key employees to get the cash out of the business in a more tax neutral manner. But really, in my perspective, the thing to do is just get the cash out, right? There is exceptions for R&D expenditures for the first 2 years where all of that cash can be clawed in to being a good business asset. But after you pass that 2-year mark, the reasonable working capital needs exception still provides a caveat saying that the cash balance can't exceed 50% of your balance sheet. I had a client just this morning email us and was like, listen, by the end of this year, we're going to have $10 million worth of cash on the balance sheet. And last time I looked, they had about $18 million worth of assets. And so,
Mhm.
that's not a great number. And so, businesses rightfully are kind of holding back some powder keg to invest into this AI world. But I think really until we get guidance from the service, the only really effective way to purge this cash is to get it up and out of the corporation, either bonusing it out or distributing it out.
Yeah, I think that's a difficult proposition for early stage companies today with so much market uncertainty, especially around AI. Like you want to have dry powder, right? Uh,
Absolutely.
you
Yeah.
know, and you know that in the future, like what scale looks like for these businesses includes sort of verticalizing things like compute, investing in like large infrastructure. This is money that like you don't just want to like it's not going to be natural or for folks to just want to dividend it out to get out of the business. So I guess what ends up happening is we'll either want to see some kind of expansion maybe just for this case, for the 2-year sort of working capital startup expenditure period. That seems like one possible solution, but otherwise, yeah, I find that you're going to raise money. For instance, for venture-backed startups, you're going to raise money when you have the opportunity to raise money, right? And
Yeah. No one's
sometimes
going
you
to
don't
say, I don't want your money right now.
exactly,
Like,
and
be
sometimes you're not.
realistic.
Yeah, you're not. Sometimes you don't touch it. We actually had a prospect raise a Series A. Uh, got really profitable, didn't touch the money from the Series A, had the opportunity to raise a Series B 9 months later, raised again. Now, at scale, the company certainly will use all of that money. They're not using it today. And so I find it difficult to, there's some conflicts there with the asset test and the way that businesses are growing in the startup space today. So we don't
Yeah.
need to spend
Yeah, no,
all
but
the
I mean,
time.
this
But I
is
want
a
to hear
good
your
point.
last
This
thoughts
is
on
maybe
that.
a good point of transition into the S-Corp. But there is, something I've been thinking about is, right, if you have a pass through today
Hmm.
that, you look at its balance sheet, you see, okay, I have, let's call it just, 30 million of hard assets on my balance sheet today. The rule when you contribute assets into a corporate entity for the purposes of availing yourself of qualified small business stock benefits is that, you look to the fair market value of the property contributed. And right, of course, you're always going to have a transfer of hard assets into a business. But what about your intangibles? What about, the goodwill you've created over the last couple years? What about going concern? And I think this is an interesting question because, right, unless you do an asset sale of a business, you don't, and you haven't been doing, a formal valuation every year, which come on, like who's doing a formal valuation at the end of every year for their business? As an advisor, I would love that because it would make
Sure.
the
Yeah.
game a lot less difficult. But, there is going to be some level, right, of like goodwill and going concern on these early stage businesses balance sheet that isn't reflected in a traditional like GAAP basis balance sheet. And so the question becomes kind of to like round out this asset test is like, okay, you have a lot of cash in your balance sheet because you're bringing in a ton of revenue at a very high, like low margin or high margin, I guess.
High margin, sure.
Um, and, but if you're bringing in that much money, your company has a lot of intangible value. And so it's also my view that in cases like that, it is probably worth engaging like a valuations expert to give you something that says, the goodwill and intangibles of my business, that are intangibles not being like the IP, are worth X, because that is a good business asset for purposes of balancing out some of the bad cash. So that's another thing, companies who need to like retain capital. I see this a lot in like the pharmaceutical space, where you cannot get rid of money out of the business in a pharmaceutical space. You need that for burn. And so like doing that sort of goodwill, going concern valuation could be a way to balance the test. Which transitions into, you also need it when you convert an S-Corp into a C-Corp. So
Yeah, I'll tell you about, as we transition into that conversation, I'll just tell you where we most often see prospects come to us and sort of have this, are starting to think about conversion. And it's a lot of times it is family transitions of asset heavy businesses. Hey, the kids are taking over. They are okay with being involved for a little bit, but they, want to try and sell the business in 5 to 7 years. We've heard about this QSBS thing, or maybe someone, mentioned, an advisor mentioned it to them, and they're trying to determine based on their expected outcome, if they were to sell, and the timeline of that, if they should try and convert the entity prior. That's a lot of what we see, or questions around, hey, we're starting to acquire a bunch of businesses. Is it something that we should look at doing that within C Corp structures or otherwise? I think those are probably the two scenarios where we see these questions come up the most. So I'm curious to hear what's sort of the straight down the fairway scenario that you guys see, and what are some of the main sort of questions that you might ask when someone comes with that question.
yeah, and I would agree. I think I'm seeing this primarily kind of in two spaces. It's the family business that's looking to, evolve and grow into maybe a third generation, moving away from family managed to professionally managed. And once you get to that professionally managed kind of area, it makes a lot more sense to be in C Corp form when it comes to, executive compensation, all
Of
that kind
course,
of
yeah.
stuff. Another area we're seeing it is startups who started in S Corp form because they wanted the simplicity of flow through from a tax perspective, but they didn't want maybe the administrative challenges that can come with having a tax partnership. That's difficult though when you need to raise capital, because the S Corp rules don't allow for a large swath of investor types to come into your business. And so it makes a lot of sense to get out of S Corp form and into C Corp form from a capital raise perspective. And then the third is really, the benefits we've seen, over the last 10 years, starting with TCJA in 2017, and kind of extending and broadening under OB3 last year, for cross-border companies. And so, maybe I'll start where I ended and work back into the sort of family transition, right? We have with tech companies especially, cross-border sales of their IP is becoming, the rule versus the exception.
Mm.
We live in a global economy, and the traditional customer base of a lot of these SaaS solutions, AI solutions, isn't going to be geographically constrained to the United States anymore. And so, some listeners may be familiar with the FDII, or it's now FDEII, FIDE, deduction, which essentially is if you have IP in the United States, you sell that IP to a foreign customer, there's a beneficial tax rate that you pay in the United States. So you're not paying the full, 21% under corporate solution. You're paying, I think, I'm not an international expert, it's somewhere in the 13 to 14% range. this was set to sunset, I believe, under TC at the end of TCJA, and the rate was supposed to go up. OB3 kind of extended that benefit. And so, where we have tech companies now that are selling their IP through, either subsidiaries or affiliates in foreign markets, that benefit is not available to S corporations. So to the extent that you have, for example, I'm working with a tech enabled company in South Florida right now who, provides one service, which is a disqualified business, but it is provided through a high-end tech platform. And that tech platform services a multinational array of affiliates. And so they can get a benefit from being in C-Corp form by reducing the tax rate from 21% down to the FDII adjusted rate on their IP. The other benefit too is cash repatriation. As we were talking about, like cash for growth stage companies is crucial. And, moving cash out of a foreign country into the United States can be less than comfortable from a tax perspective if there's no tax treaty. S-Corps widely do not qualify at the entity level for tax treaty benefit. You have to look through to the ultimate S-Corp shareholder, and that makes that challenge a lot more challenging. And so switching into C-Corp form over S-Corp form from an international perspective kind of unlocks this really efficient strategy. And if companies and growth stage companies especially are looking to expand outside the US market, it's really beneficial for them to flip into a fully corporate structure. On top of the QSBS benefit that they have, that, we modeled this out for a client, and between the, the sort of international benefit at the corporate level they were going to get on top of the QSBS projected benefit, we kind of had an idea of where they were going to exit at. Our understanding is they were going to, over a 5-year period, including, cash tax savings and exit, going to save about $35 million in U.S. federal income tax. So it was a meaningful amount of savings going from S to C.
And that's a growing and important service too. I think in the QSBS space is like choice of entity modeling.
Exactly.
Which folks have been doing for a couple of years now, but I'm hearing it brought up as sort of a core service of advisors in the QSBS space now, because it, if you have good, if you're able to fairly project the course of your business over, X period of, short to moderate amount of time, it can be a extremely valuable service, because it's just, at the end of the day, it's sort of a math problem, right? There are other considerations outside of, spreadsheet numbers, but it's sort of a math problem.
And right, like tax should not wag the commercial dog. At the end of the day, commercial drivers really should be the play a big role into entity choice. But, this is not a benefit you can ignore going into QSBS. And that especially, right, if you want to raise outside capital, which I think transitions into kind of the second bucket I'm really seeing, which, for people who maybe don't practice all that much in the S-Corp space, really the only shareholders that are eligible in an S-Corp are U.S. persons and certain specified trusts. And so that can be really challenging, where you want to bring in venture capital money or other family office money or, foreign money. That will disqualify you from being an S corporation. And, as anyone who's dealt with an accidental termination of an S corp will tell you, that's a really painful process for everyone involved. And so, right, the way, and there's a great article out there about the 3 good ways to convert from an S corp to a C corp from Mark Melton at Holland and Knight. And so, who I believe you've had on your podcast before, do there is the safest way to do it, and the way I always recommend to clients is you keep your S corp around. That becomes your private wealth holding vehicle. And then you just contribute all of the assets down into a newly formed entity. That can either be an LLC that elects to be a C corporation, or it can be, a state law corporation. If you're taking on foreign money, it's been my experience that they want a Delaware C corporation. if you're only going to take domestic money, I tell people, right, it's ultimately a question for your lawyer, but LLCs have a lot less governance requirements than state law corporations. And it's still, if you make the election, it's still a corporation at the end of the day from a tax perspective. So yeah, you drop the assets in what I call an assets down transaction. You get your original issuance at the S-Corp level, and you proceed as moving forward. The trick is, however, though, and I don't know if you've discussed this before on your podcast, like any pre-contribution built-in gain that you had while you were in S corporation form is not going to be eligible for 1202 on the exit. That's a provision under 1202I. And so it's really important to understand your tax basis in the assets as compared to their fair market value. Fair market value, as we said, really important when doing these conversions because you have to be under $75 million of fair market value at the time. But you need to also figure out what is my built-in gain for when you ultimately exit, because that is not subject to the exclusion.
Yeah, so the dollar amount up until the built-in gain will be taxable. Let's say that's $15 million. And then in 7 years, you sell and you're QSBS eligible 100%.
Yeah.
For, I don't know, 30 million. The difference between the two could be, depending on how you plan, could be covered under 1202.
And maybe a question that practitioners can be thinking of. I received this one recently, is whether or not the 1202I built-in gain is subject to the higher 28% rate versus the standard 21% rate. I don't take that view that it is, because the QSBS gain section says by reason of 1202A, and that built-in gain provision is under 1202I. And so I generally take the position that you kind of spread the 1202I built-in gain across each share of the stock. So if you do a partial liquidity event like midstream, say you sell 40%, you recognize 40% of your 1202I. But that, that's always kind of to the trick when you think about the valuation of your business going into C-Corp form. You want that basis, or you want the fair market value to be high enough that you get a really great 1202 exclusion amount, because, right, you're typically getting a 10x basis multiplier in these situations. On the flip side, if that valuation is too high, you have a larger amount of built-in gain that's not subject to the taxation. So it is kind of a balancing act of, like, you want to make sure your valuation is correct and prepared the right way, but too aggressive of a valuation can lead to some not so great consequences kind of on the back end when you exit.
Yeah, I'm seeing it more popular to hear not necessarily tax or legal people, but startup advisors talking about, hey, you should start your company in a pass-through so that you can take advantage of 10x basis when then, you go to fundraise later, or, when you eventually convert, as sort of a de facto always start in that structure. I tend to, I don't know, not sure. I love that as just like blanket advice for startup founders, especially who know
it makes sense for some people.
Capital,
like,
but
yeah, like if you're a business that's going to be raising capital really quick, and like I don't know that play makes sense, because, right, you're going to have all of the complexity of capital account management at the partnership level, like tracking of pre-contribution built-in gain to the extent that there's property coming in. Like, partnerships are messy when it comes to tracking the economics as compared to a C corporation. So I think if you're starting a business with your friend out of your garage, and you think it has a massive potential, starting in flow through and then flipping into C Corp may be a good answer. If you are a, pharmaceutical company that's going to go buy IP that maybe didn't make it through clinical trials for the purpose it was initially intended for, but you think there might be another benefit, which is pretty common in that space, like, I almost always recommend going right into C Corp form. You're going to be fast growth, you're going to be fast capital raise, and people are going to get a better benefit as they kind of continue to transition.
Yeah, I agree. Yeah, I think that it sounds good on the surface, but as blanket advice, one, it assumes that your business will grow to the point where like the 10x basis is actually, a massive boon to the
Yeah.
early stage founders, which obviously all of us think that our businesses can be worth five, six, $700 million or whatever. But in general, I think that there are many complications like you mentioned that get missed along the way
Yeah.
by doing that, and sort of it's an example of the tax tail wagging the dog. I think in that instance. What are some? So okay, maybe that decisioning is one area where a company might get things wrong early on or just like make a suboptimal decision. What are some other ways that you would sort of call out as like, hey, make sure to avoid this common mistake in planning around these types of transactions? Is there like a common problem that comes up that you end up being called in to help undo? Or is there a proclivity that you have to sort of talk clients back from, hey, I know you think that we should do it XYZ way, but actually we should do it this other way. Are there any commonalities there?
Yeah, I mean, the biggest thing, right, is just where you maybe have done a transition from C or from S to C before. And a lot of it is, experienced corporate counsel advised you on this transaction, but you didn't have your tax advisor. And, they didn't do one of the sort of three really only ways that you can do, or actually, frankly, there's really only one way you can do the S to C Corp safely to get QSBS, which is just dropping the assets into the C corporation. I've seen some somewhat creative approaches using like contributions and notes to get original issuances. I would say if the simplest you can keep the movement of assets of the business into C Corp form, it is the best way to do it. Obviously, do not contribute your S Corp to a C Corp. That does not work point blank. But keep it simple. I think a lot of good tax planning is just like looking at the code. What does the code say is the way to do this? And 1202 says that you have to contribute non-stock property or cash in exchange for stock. And you can hold that through a pass-through. So just taking this, what seems like the easy and simple way to convert from S to C, I think, frankly, is going to save investors a lot of heartache. We do have a lot of people, right, who've also have been a C and then moved into S because they thought it was good for a couple of years and then have terminated their C. There's a view that, right, I received at original issuance C corporation stock because for, 2 or 3 years, right, I was a C corporation before I moved into S-Corp form. I take the view that that can work, but you don't get to count the holding period while you were an S-Corp because you weren't qualified small business stock. I would still recommend that if you do that sort of SC and want to go back to C, you still do the drop into a new C. It is by far the cleanest. It is really challenging, however, though, if your S corporation just holds a bunch of stock in other corporations, right? Because if you just drop the assets of your S corporation into a new C corporation, you're still dropping stock, and that's not a qualified transaction.
Mm-hmm.
So I think my biggest piece of advice is no one situation is the same as another. All these transactions are going to be bespoke to some level. Making sure that you have a great tax advisor, both accounting firm and law firm, kind of on your side when you do this is absolutely critical. I love working with really good law firms who kind of know the sort of legal commercial issues at play, and partnering with them because I think it gives the client the best outcome possible from a tax planning perspective.
I agree. The role of corporate counsel should be to protect the commercial interests of the business, as they may have insight into other aspects of the business and the strategy going forward. I think that's a really important dynamic to try and facilitate with your advisory team for sure.
Yeah.
Yeah, that's a good note. The last thing maybe I want to mention is we see a lot of the assets in these types of these businesses, especially in private equity, lower middle market, or just like outside of the venture space. Maybe there's heavy real estate assets. Sometimes those
Mhm.
assets could be passive or income producing in some way. Um, any particular concerns or recommendations dealing with real estate in these instances, and
Yeah,
without getting too deep into like the complexities of all the different types
yeah,
of
of course.
ways that you can own real estate, but with 1202 in mind.
Yeah, I mean, what I have started putting into place is a bifurcated structure. So, I had a client who did had a kind of a real estate business that was tech enabled. And, right, 80% of their revenue at the time was coming from the rents received from the real estate. 20% was coming from the tech platform that was used to kind of make the business really what it was. But the future incremental value to the business was going to be the growth and expansion of the software product. The real estate, really, when you're just doing rent, kind of has a fixed upside. Like you
Sure.
don't have a lot of exponential growth there.
Yeah, you can't increase rent 200%.
Yeah,
You can
exactly.
increase software sales 200%.
So
Yeah.
what we did, right, was they were in S-Corp form to begin with. And so we're like, okay, this software company today is only servicing our real estate business. But there is the true commercial unlock for the software side of the business was to service not only our business, but to sell our product to our competitors. Because, our integrated package is still going to be better than their package with our software. And so what we did is we carved the software side of the business into a C corporation. We did an LLC drop, checked the box closed to make it a C corporation, and then we dropped the real estate in a passive vehicle because you very rarely want to have real estate in corporate solution.
Mhm.
Almost never want real estate in corporate solution. Um, and so you still got the benefit of the flow through real estate with the benefit of the QSBS. There was foreign real estate as well that was using the software. So the royalty fee that was paid back to our US software company benefited from the FDII deduction. And so, where you have these mixed businesses where I call them tech and like I am a a lot of companies view themselves as a tech company only, but from a commercial perspective and a tax perspective, you're really tech and real estate or tech and insurance. And so separating the and from the tech, I think is the best way to like set up a structure from a 1202 perspective that gives you an upside on exit while maintaining your commercial operations. The one thing I will say, proper transfer pricing between these parties is absolutely critical. Um, that's where accounting firms and law firms need to work together even more once you do the conversion is making sure my transfer pricing documentation and transfer pricing, sort of administration are being done in accordance with the transfer pricing rules, both in the US and internationally. Um, if you do it right, though, I think that there's a huge amount of value proposition for these sort of tech end companies to drop out of flow through solution and into sort of a semi-blocked, semi-flow through solution. Um, the client that I was mentioning earlier with the $35 million savings, that was kind of the thesis of our restructuring for them.
Yeah, I think everything you just said is also germane to businesses where there's significant consulting services done
Exactly. Yeah.
as well. Every tech company is a consulting business, right? Just about, because if you have an enterprise solution, a custom enterprise solution, you're doing some level of
Implementation consulting. Yes, exactly.
exactly. And so that's one of the gray areas in 1202 is just like consulting businesses. Well, we're all sort of consulting. That's what we're doing. That's what we're doing. And so
Yeah.
understanding what that means for your business in the specific context of how you deliver services and generate revenue is important. It's an important question to answer, how you're going to bifurcate those things, whether it's consulting, real estate, healthcare, any of these sort of maybe like gray area categories where you could think, oh, maybe this does or doesn't fit under 1202. Yeah, there's a good questions to ask. Um, yeah, thanks a lot, Blaine. We'll wrap up here, but I appreciate sort of flagged a number of excellent questions that folks need to be thinking about, as well as ways to think about putting together the right advisory team. Because I love that you sort of called out that your corporate counsel and your tax advisor playing very distinct roles in these transactions, and both are very necessary to get the full picture of what can be accomplished. So, yeah, thanks for your time.
Yeah, of course. Looking forward to seeing everyone in Jackson Hole. So
That's right. Yeah, we'll see everyone there. Thanks, Blaine.
yep.
Thanks for tuning in to this episode of QSBS Solved. You can find more content online at QSBSrollover.com.